COVID-19 to Wealth 20 very successfully. First of all, I would like to thank the audience for such a wonderful response that we have got over the last 45 days of these informed sessions. In 1 minute, I would just like to explain, we are a new age investment services company. We have been doing two things really well. One is the wealth management, and second is helping investors take informed investment decisions. And doing these webinars during such unprecedented times is a step in that direction, where we are helping investors make informed investment decisions. Today, we have Mr. Niraj Shah, who is the moderator, who is the chief editor from Bloomberg. He and Navneet would do an insightful session. Over to you guys. Thank you very much.
Thanks, Kamal. And of course, I look forward to seeing you come in a bit later on and do the Q&A along with Navneet as well. It'll be really nice to answer some questions from that audience would have as well. So look forward to that too. I think we'll do that in about 20-25 minutes. So that's the small thing. But Navneet, good having you. Good talking to you. It's been a while. Thanks so much. What's your sense, Navneet? Is the smile a sign of the confidence that you have around maybe the liquidity situation around the world being benign and taking care of issues? Or do you fear that sooner rather than later, the real economy issues could come and dog the markets?
So regardless of the environment, Niraj, it always helps to keep smiling.
That's true.
But on a more serious note, I think globally, clearly the public discourse seems to be moving from survival only to revival also.
Yeah.
And I think initially several governments, particularly at our end in India, we focused a lot on stringency of the lockdown, and then of course supplemented it with the stimulus to contain the economic damage. But over a period of time, we are seeing in most of the other parts of the world and in India also, how do we come back to normalcy? How do we learn to live with it? Because nobody really knows how much time it will take for the world to really find a vaccine or a medication. Though we are positive on antibody tests, but we have to see the efficacy and how they can be used. Till such time, I think we'll have to learn to live with it. And clearly, I think we are seeing across the world, public discourse clearly moving in that direction. And I always give this analogy of air travel and road travel, where initially a lot of risks were there with the flights as well as the automobiles on the road. Over a period of time, both in terms of infrastructure, the license to drive or license to fly, and then all the other measures have reduced the risk. And I think something similar is likely to happen. All we need to do is, I think, how do we take care of people who are old and vulnerable? I think the society can find a good solution to that and provide a safety net to them. Then maybe rest of the economy and younger people can come back to work. And I think that's why maybe over the last couple of weeks, we are seeing markets, I think, trying to see some bottom that maybe over a period of time, we are going to learn to live with it. Apart from the huge stimulus that has been provided by the global policymakers.
So, I just want to understand from you, Navneet, when you decide to either put in money or try to asset allocate, because you are the largest money bag in the country currently, what takes center stage? Is it the global factors, the US-China spat and the liquidity thereof? Or do you reckon that what India is doing, trying to do and missing out on doing takes center stage right now?
So I think a mix of all of those things. Of course, I mean, just before this crisis, go back in the month of February, we were looking at a bottoming of the economy, a revival driven by the rural economy, some of the other measures taken by the government, particularly on the taxation side, on corporate tax side, how FDI flows can go up, so on and so forth. And suddenly this risk came completely unexpected, unprecedented. And then we have seen a massive response from the global policymakers, which has also impacted all the markets, including the Indian markets, and of course the reaction or the response from our policymakers. So all of those things impact the asset markets globally, including our markets. This year, interestingly, we have seen one of the biggest selling, if I go back in history, by the foreign institutional investors, both in the equity and debt markets. So of course, the global markets impact us as much. But over a period of time, from our perspective, though the asset allocation decisions are broadly done by our investors, but the way we manage our equity and bond funds, on the equity side, we are a lot more bottom-up investors, and on the bond side have been bullish on the duration, have been cautious on the credit, and we can discuss more that in detail.
Yeah. So, Navneet, simple question: किसका पलड़ा भारी है फिलहाल? Is the US-China spat the more dominant piece right now? Because it was in 2019 when we didn't have COVID.
Yeah. No, I think all of those, I think the animosity towards China has really accentuated. It was there even before the COVID-19 and has only got accentuated. And it will have its own repercussions. So I think the rising geopolitical risk in the world can work in two ways. One, of course, it will impact the global growth. It will impact global trade. It will impact our potential in terms of exports. But the other way to look at it, whether India can take advantage of the opportunity that can come our way. So I think if we can present ourselves as the next big investment destination, given our domestic demand, our demographics, our labor pool supply over the next several decades, so on and so forth, I think it could be an opportunity also for India. So I'm sure in the very near term, rising geopolitical risk will keep the risk-on sentiment under pressure. But on the other side, from a medium to long-term perspective, if the policy response is right, then it could be an opportune moment for India.
Difficult to say what would the right policy response be as well, Navneet, right now, right? So therefore, my question is, what is it that you are doing when you're making these decisions? I think that's the crux of the question. Because a lot of people that we speak to are saying that there is no point in trying to figure out the damage in quarter 1, quarter 2, quarter 3. Let's write off FY21 completely. Let's look at normalized FY22 earnings and then try and ascribe valuations. Is that the right approach? If not, are you doing a mix of something else? Can you speak a bit about that?
No, you are absolutely right. It's very difficult to predict how the growth is going to pan out, how the overall situation is going to pan out over the next 6 months or even 12 months, or maybe we don't know 18 months. As of now, there is considerable uncertainty on the front of health crisis, the effectiveness of the stimulus which has been given so far, uncertainty on the economic growth front, and uncertainty even on the longer term implications of this crisis. How consumers, policymakers, businesses going to react to what we have seen in last 2 or 3 months. Now, looking at all of that, it's better to focus on a longer term picture. I mean, look at individual companies, and that's what I mentioned in the beginning. Focus has to be on a bottom-up perspective. Look at individual companies. Take the worst possible scenario over the next couple of quarters and see whether the company has got the liquidity, the ability on the balance sheet, ability to raise capital if need be, or raise liquidity if need be. And they have they not only survive this crisis, but really invest, really put those efforts in place where they can actually thrive over a longer period of time, and bet on those names.
Okay. I mean, I'll get to that piece as well. Just wondering, what do you, I mean, when you're obviously investing, taking a bit of tactical calls as well, right? I'm guessing when you're looking to invest money versus maybe sitting a bit on cash or trying to be in defensives. What's your larger call? Do you think that the globe will stay safe because economies are opening up and there is liquidity? Or do you think global markets too, particularly the US, which has had such an amazing run in the last 1 month, could come off a bit? What's your sense? Do you have a sense there?
So interestingly, I mean, India has really underperformed meaningfully over the last few months. I mean, US markets are close to their all-time peak, despite the fact that whether you look at the health crisis or the impact on the economy or the unemployment data which has been coming out, all the other high frequency data that have been coming out, clearly, I mean, there is a deep economic damage. But given the composition of the market, where a large part of the market is those technology companies, media and entertainment, and some of the sectors which are less impacted by this crisis. In fact, some of them are positively impacted by this crisis. I think that has clearly helped. And the amount of stimulus is absolutely unprecedented. What the US Federal Reserve is doing, and the comment by Janet Yellen last week that Fed should not shy away even from buying equities if need be, and the amount of fiscal stimulus that they have thrown, I think has surely supported their asset markets. Now at our end, I think the overall stimulus is of not that magnitude. Bulk of the heavy lifting has been done by the monetary policy. We may have to do a lot more on demand stimulus, while government has tried its best to give a combination of how to give a multiplier effect by those guarantees, etc., to the monetary stimulus, as well as I think some good path on some of the structural reforms, particularly on the side of agriculture, public sector, on state level reforms, etc. I hope that we continue to do both of them, a lot more demand stimulus as well as remaining on the path of structural reforms.
Just one last question, Navneet, on this global versus India in the relative case. Would it happen that the US markets, because of the stimulus and the balance sheet, etc., do well for the better part of the current year, but EMs at large and India in particular underperform, or correct? Could that happen?
So over the last 10 years, US markets have significantly outperformed emerging markets, including India, if you look at in the dollar terms. Whether that can continue over the next 10 years, I think if I look at the growth versus the valuations today, I think emerging markets clearly present a good opportunity. In the very near term, given the stimulus and the response which has come in US, and as I mentioned about the composition of that market where financials are a much lower part of the market, again, the commodities companies, which particularly within the emerging market context has a larger weight, which have got negatively impacted by the commodity prices fall, may get impacted. But if I look at the next 10 years, I think in terms of whether the demographics or the demand potential, and also an indirect beneficiary of the overall stimulus in the world, even by the developed markets, I would bet the money on emerging markets over the next 10 years, despite the fact that last 10 years they have underperformed. And within that, India, I think it's really puzzling that over the last few months, I mean, the way India has underperformed not only the global markets, but even the emerging market peers, notwithstanding the fact that we are a commodity importer. We should have been a beneficiary of that. We are a lot more domestic demand-driven economy rather than dependent on the global demand or the global trade. But maybe I think that's a clear signal that why foreigners are voting with their feet. I think it's a message that we need to do a lot more from a policy response perspective to get foreign investors back in our markets.
Okay. How do you defend the argument of the valuations that India would be at, Navneet? I mean, with the presumption that you are bullish, 18, 19 times trailing earnings in a scenario like this, is this acceptable because relative to the other markets?
No, the statistical concept of mean is always.
Yeah, sure. Okay.
I mean, we should pay too much attention to that because that 18 times hides a lot of things. I mean, there is clear so much of polarization in the market. I think the broader markets peaked, I think, sometime in December 18, early 19, December, the early part of 2018. And you look from, I think you go back and see the market direction from that. If you remove the top 15 companies, then markets are substantially lower than where they are today. And the top 15 companies are closer to the all-time high. And if you look at the mid-cap 100 index, the top 15 companies are close to all-time high versus the remaining 85 companies are like 35-40% lower than where we were 2 years back. So clearly, I mean, there is huge polarization in the market. Now, this crisis has only accentuated that polarization. Now, if I have to invest from a 3 to 5 year perspective, not necessarily that you should bet only on those 15, 20 names. But of course, one thing you have to keep in mind is that who has the ability to survive this crisis, because there is so much of uncertainty ahead of us but on this crisis.
So, Navneet, would you dwell a bit upon, I mean, how would you like to structure this now? Would you want to talk about what asset classes look poised for better gains, or within equities, what looks better, what doesn't look better?
No, sure. So let's talk about whether equity or bonds, maybe on the bond side. So clear view is that looking at the global environment, looking at the growth inflation dynamics, where RBI mentioned that we are going to have a degrowth first time in our history. Now, if you go back and see our history, the earlier cycles, the 10-year bond yield bottomed at 5% or even below that in January 2009, or you go back to 2003-04. We are more closer to 6% today. Both the term premiums as well as the credit spreads are substantially higher. Given the uncertainty on the economic front, one would be cautious on the credit side, would like to play it through the duration, maybe in the near term, we just consolidate the gains that have been made. But I think structurally, rates should be lower than where they are today, and that's how you would play that. At some point in time in this year, I think given the steep yield curve and the very high credit spreads, at some point in time, even credit markets would become very, very attractive. This is not a war. The assets have are not getting completely demolished. I mean, you have those assets, and at some point in time, they will be valuable again. So if you can put the right collateral, right covenants in place, I'm sure credit markets will also throw interesting opportunity. May not be in the form of a T+1 liability credit risk fund, but maybe in an AI format, a special situation or a stress debt fund could be very, very interesting. Coming to equities, I think I'll go back to the same point that one has to be completely bottom up. You have to really look at individual companies and see whether they have the ability to survive this crisis, and taking the right steps to take advantage of the consolidation that will happen in every sector. We are going to see a massive creative destruction. A lot of people may not be able to survive. I think those people who are taking the right steps today and have their balance sheet in the shape where they will be able to survive this crisis, I think they will do well. And we can discuss a little more in detail.
Yeah, sure. So I'll get to that too. So, but the moot question, Navneet, would be that we are likely to see massive GDP contraction, job losses, and salary cuts are a reality. India has largely been a consumption story, right? Is that consumption story under challenge for a longer period of time, or is it only for the next 3 to 6 months? Are you guys making a hypothesis? You may well go wrong, right? Who knows? But what is the hypothesis you are making?
So, I mean, there are many Indias when you look at the consumption. There's a very small part of the population who consumes the way you would see people in the developed markets. There's a large part of the population where the consumption is even lower than some of the emerging markets. I think they are more closer to frontier markets, maybe sub-Saharan Africa. The near-term outlook surely is very hazy. A longer-term outlook from $2,000 per capita, I think we have a long way to go. Relatively, just talking about the consumption, relatively, I think that rural India seems to be in a better place on a relative basis than the urban India. Unless that these migrant laborers, when they go back to their villages, if the disease spreads there, then we'll have to wait and watch. But otherwise, I mean, looking at the better monsoon last year, higher water levels, I think good food prices, harvesting has happened. Likely that we get a good monsoon this year as well. The wealth effect has been positive because gold prices have done very well over the last few years. And I think some of the things that we have done in last few years, particularly on social security, on road connectivity, digital connectivity, banking connectivity, electricity connectivity, and all, over a period of time, there's a possibility that rural India does well. And so bottom of the pyramid consumption, even on the discretionary side, there could be opportunities. So again, I mean, we can talk about other aspects of consumption, but I think India has a long way to go. In the very near term, high-end consumption will surely take beating because people would like to save money and people would like to consume less. No doubt about it.
Okay. Now, viewers, remember, for the viewers logged on to the BloombergQuint social media platforms, this is the last question. The session continues, of course, for the PMS AIF subscribers who have logged in via the listing. But for the BloombergQuint viewers, this will be the last question. And then we will, of course, continue the session, but without it being on BQ. But Navneet, just a follow-up to that then, the larger picture, because there's a set of viewers who will be leaving right now, the larger picture might be, please correct me if I'm wrong, but what I'm trying to get from you, or what I'm understanding from you in the last 15-20 minutes, is that if one ignores the hiccups over the next 6 months, arguably the normalized picture will look a lot better and people shouldn't be too worried. I think that's the message that you're probably working with.
So I wouldn't put that number whether it's 6 months or 12 months or 18 months. I think the longer term picture will improve, one, because big reforms happen when you have a crisis. Because they always happen out of compulsion. And the compulsion of this may lead to structural reforms. From a global perspective, both the cheap liquidity as well as the geopolitical crisis, particularly between US and China or West or China, can benefit India in various ways. This could also be a big opportunity in sectors like healthcare, in technology. I think the potential of data revolution in India has been underappreciated. Of course, in the last couple of weeks, the kind of deals that we have heard on one of the technology platforms, now it's getting discussed in global media, it's getting discussed in global boardrooms. And I'm sure whether the supply chain shifting to India, whether the technology platforms in India, whether another Y2K movement in healthcare or in broad digital technology, all of these are positives. One more positive for India relative to the previous crisis is I think the external side is on a relatively better shape with $486 billion of reserves. getting invested at 1% or so, I think we can make better uses of that. The challenges at this point in time relative to earlier crisis is I think our fiscal capacity is very limited. Financial sector is not in the pink of its health. And I think if we are able to put I think if we are able to do the right things on those two fronts, I'm sure I think India can not only come out of this crisis, but I'm sure we'll be able to take advantage of a lot of opportunities that can present themselves on the other side of this crisis.
Okay. Lots more to talk about for the PMS AIF viewers, but for the viewers in BloombergQuint, thank you so much for tuning into this broadcast. It was obviously lovely listening in to Navneet Munot.
Thank you, Niraj.